Hey guys, this is Steven. We are ready to rock with the IUL bootcamp. We have got Gina Hawkes with us. She's going to go through the basics of IULs. I know a lot of you are going to be watching this on a recording because we had all of you on the dial jam yesterday, booking up today and Wednesday, and we know you'll be right back on the dial jam on Thursday to book up Friday, Saturday, falling into that Monday, Thursday dial jam. So just before we get started, one thing I want to make sure I say, especially since we're recording this, every middle American family needs an IUL. And I say need is as in, I'm like dead serious, needs an IUL. It is a vehicle that will allow middle America to plan for and actually enjoy a retirement. You think about the options people have. Most middle American families don't have life insurance. The ones that do don't have enough. And the ones that do, that don't have enough, also aren't saving enough for retirement. It's only through an IUL that most of these families will have a shot at anywhere near a decent retirement. So when I say every middle American family needs one of these, I'm saying if we're meeting with clients that are in the age range, we're doing them a disservice to not bring the IUL to them. We're doing them a disservice to not schedule an appointment the following week after we sell that mortgage protection or whatever that basic first product is, and come back and show them something this powerful. It's something I've always believed in since I first saw them. So I first saw the concept, I was in, and in as in we own a bunch of these. We own a bunch of them. And so if you're watching this for the first time and you don't have an IUL, this would be a call to arms. It's time to get yours. When I sell IULs, I show my IULs. There's nothing more powerful than that, showing your IULs to people. And like I said, every family we're meeting with that's in the age range, and Gina will walk us through all that. But if they're in that age range and they're in good health, we were doing them an absolute disservice to not bring this to them. It is such a powerful product. So it's not as scary as it sounds. It's not as intimidating as it sounds. If I can figure it out, I know you can figure it out too. But with that, Gina, I'm going to turn it over to you. I'm going to mute out and listen in.
Okay. Can you hear me okay?
Loud and clear.
All right. Awesome. Well, hello, everybody. And I do have the chat box up as well. So if you have questions as I'm going along, please ask, because sometimes I've done this so much and I know it that, I'll go rolling through stuff and it makes sense to me, but it might not make sense to anyone else. And that's not a good thing. So as I'm going along, if you have any questions, please ask, because I'm sure if you have a question, someone else probably has that same question as well. So what I want to kind of go through today is, first of all, I want to talk about who is the right prospect for an IUL to make sure that we're talking to the right people about these products. I 100% agree with Stephen. Middle America needs these products, and the awesome thing is hardly any of them even know these products exist. They don't know the concept of tax-free retirement is out there. They don't know how they can utilize life insurance. So that's great news for you, because there's tons of opportunity out there with helping people out with these products. So I'm going to kind of talk about who is the market, and then I'm going to kind of go through just how an IUL works at like a 30,000 foot view, not getting into a whole lot of nitty gritty, but just the basics. And it's not what I would explain to a client. I actually just got off of an IUL call with an agent and a client, going through some things and explaining some things. So some of what I'm going to talk about today is going to be to help you as an agent to understand how these work. And then I'm going to talk a little bit about how we use that and explain it to a client. And then, of course, make sure that you know that if you're on this call and you're brand new and you're like, I don't know what an IUL is. I don't even know how to spell IUL. That's fine. Just find the right person, find the prospects out there, and we have resources here at the Alliance to help you. And so I want to talk about those resources and how you can book an appointment. Just like I said, I just got off of a Zoom with an agent and a client, and we were going over some illustrations, and they had some specific questions, and I was going through and answering those and explaining things. I can do that for any of you. So if this is all new to you, then don't worry about it. You've got the resources to help you, number one, learn it, but also be able to help your clients in the process and get paid. Yay! That's always a good thing. If you guys don't need the money, I'll give you my bank account number and you can send it to me. But yeah, I mean, it's like a win-win-win situation, because you get to go ahead and help your client out before you know all the ins and outs of how this works and how to explain it to them. You get to go ahead and get this amazing product in their hands so they can start saving for their retirement. You get to learn in the process, because that's the best way to learn this, is to do it, and you get paid to do it. So I want to talk about that. So that's kind of what we'll go over today. I do want to keep in mind and just help you guys to remember the way that we get to these IUL clients is through mortgage protection, sometimes final expense. It's probably the final expense clients, kids or grandkids, that we would help with an IUL, which will make sense when I talk about who the market is. But that's how we get to these people initially, is through our leads. So if you want to sell more IULs, then it's, we need people on big GMRs for final expense and for mortgage protection leads, because that's how you're going to find these clients. We don't have an IUL lead. We do and we don't. We don't have a specific IUL lead that someone sends in a card that says, I want information about an IUL. We do have, sometimes the internet will generate a few of those leads, but if you wait for those, you're going to be waiting a long time, because it doesn't generate that many. But all of these IULs that people are selling, it's getting to the clients, getting to the referrals. You sell a final expense policy and you find out that their children need help with their retirement. That's how you're going to sell IULs, is getting in homes for mortgage protection and final expense. So we want to make sure that you have the resources to get you in the home, so that once you help the client with what they asked for, then we can also help them or their family or their friends or somebody they work with or somebody they go to church with or whatever, help them to plan for their retirement. So that's how you're going to be selling a lot of these, is getting leads and going out and talking to people initially about mortgage protection, final expense, and things like that. So who are we looking for? So you're sitting down with someone and you're like, I know this is an awesome product. I know it's a great way to save for retirement, but who is the right prospect? Because these don't work for everyone. They do work for a lot of people. And, like Stephen said, younger middle-income America, this is a perfect way to save for retirement, and people need to be saving more for retirement. I'm talking to a lot of these clients, and they've not been saving, and now they're older and they're trying to catch up. And it's like, well, I want this amount of income in 10 years, but I only want to spend this amount of money to get it. And the two don't match up. And it's like, we're not magicians. We can't make money up here out of nowhere. So the younger people start, and the more you talk to people about starting to save for retirement, the better you're going to be at this, and the more people you're going to talk to and be able to help. So there's basically three things that I say the client really needs to be able to check all three of these boxes in order to be a prospect for an IUL. And I'm going to tell you the three, and then I'm going to talk a little bit in more detail about each one. So the first one, if you're taking notes, the first one is they need to have about 15 years, 15 years before they want to start taking money out of this policy for retirement. So 15 years from retirement, or they have some other funds that they can start taking retirement out of and then tap into this. But they really need to let it set for about 15 years. It can be a little less. We're not going to talk about the exceptions. We're just going to talk about in general. For most people, it needs to set at least 15 years. So if somebody's like, well, I want to retire in 5 years, this is not going to be the product for them. We have other products for them, but it's not going to be an IUL. It's just not enough time to let it set and accumulate. Second thing is they need to be relatively healthy. And again, I'll talk a little bit about that. Relatively healthy. And the third thing is they've got to have some money to put into it. We're trying to save for retirement here. We talked about the 15 years. There's really two things that you need to save for retirement, and that's time and money. And this is no exception. You know, we haven't found Jack's magic beans that you can pay $50 a month and in 5 years you're going to have $1 million in there for retirement. No, it's going to take some time and it's going to take some money. And I'll talk a little bit about how you get to each of those as we go into them. So first thing, the 15 years. The way I explain it to people is it just takes time. It just is what it is. There are other products if you've got someone that needs to retire earlier than that. It's not that there's not products out there for them. It's just the IUL is probably not going to get them where they're trying to go in the time period that they're wanting to do it. It just takes time. And the way I look at it is like the difference in two different kinds of meals. So some of you may prepare these amazing home-cooked, wonderful meals that take a lot of time and a lot of energy and a lot of love, and at the end, it's amazing, but it takes some time. And if I don't sound like I know what I'm talking about, it's because I don't cook like that. I am the, let's put it in the microwave, and in 15 minutes, dinner's ready. I'm that kind of, I don't like to cook. I don't enjoy it. I don't have time to do it. So I'm like, hey, let's just find something that's going to be ready in 20 minutes. Not as good, not near as good as that home-cooked meal. So in the end, it's going to be so much better. It's just going to take some time. That's how an IUL is. It is not the instant gratification. Let's put it in the microwave, heat it up, and boom, it's going to be ready in a few years. No, it's going to take some time. It's going to take some patience. It's going to take that money going in there and letting it set and accumulate. But at the end, it's going to be awesome. So it just is what it is. It's a product that accumulation-wise, it's incredible, but it does take time. The other thing that I'll tell clients is when I'm explaining why you need to let it set, you know, I will tell them it's just like anything else. You know, you put money in anything, the longer you let it set and grow and earn interest, the more money you're going to have. This is the same way. And these policies in the beginning, they have more charges in the beginning years than they do in some of the later years. So it just takes some time for it to accumulate. It just is what it is. Most people don't have a problem with that. Again, we don't want to be talking to those people that are like, I need money in here to get access to in 5 years. This is not going to be the product for them. Be thinking 15 years before they want to retire. Relatively healthy, our number 2. I know you guys talk to these people every week that are like, oh yeah, I'm healthy. You know, I don't have anything wrong with me. And then you start asking them some health questions and they're like, yeah, I've had a little bit of heart surgery. You know, kind of like being a little bit pregnant, a little bit of heart surgery. You know, they did like a quadruple bypass a few months ago, but I'm good now. You know, they cleaned everything out. I'm healthy now. That's not the kind of healthy I'm talking about. They need to be relatively healthy. And the time and the health, that's going to make more sense when I kind of talk about how the IUL works at that 30,000-foot view. But these people need to be relatively healthy. If they have some pretty serious health challenges, then again, it's not that we don't have a product for them. It's that the IUL probably isn't the product for them. And it's not just health either. It's also criminal record, driving record, you know, all of that comes into play in the underwriting. And we're trying to keep the cost of this policy as low as possible. And when you start adding health conditions and driving record and all that stuff on top of it, it just shoots that cost up to where it may not be cost effective for the client to save for retirement using this type of a vehicle. So relatively healthy. And then the third thing, the money. So I'm going to give you a secret. It's not really a secret. I've heard Justin Bailey and Sydney Lagagianis talk about it several times. And I've talked about it several times on training. But the first time I heard them say it, I was like, I love that. And they were talking about how well it works. So I started implementing it on the IUL appointments that I'm doing with agents. And it's incredible how this works. I'm just blown away by how it works. So I said the third thing is they need to have some money to put into the plan. Obviously, just like the interest, the more money they put in and the longer they let that money set and grow, the more money they're going to have in retirement. So here's the trick to getting higher premiums when it comes to IULs. This is not how I used to approach it. And then once I heard Justin and Sydney talk about it, I changed how I asked the question to the clients. And this, I'm just telling you guys, this works like magic. So as you go through and you're explaining everything, you're explaining how it works, you're answering the client's questions, all that, ultimately you're going to get to a point, and this is exactly what the client I was just talking to said. You know, we went through and explained everything, and he said, okay, well, what's this going to look like for me? Like, how much money do I need to put in? You know, if I want to have a certain amount of money in retirement, can you tell me how much I'm going to need to put in to reach that retirement goal? But ultimately, you're going to get to that question of what does it look like for me, or how much money do I need to put into this? So when you get to that point, here's what you do. This is what I learned from Justin and Sydney. You say something along the lines of, if you're like most people, because people like to be like most people, if you're like most people, you realize that to save any kind of significant money for retirement, so if you're like most people, you realize that to save anything significant for retirement, you need to be putting away at least 10% of your income. So if you're like most people, you realize that to save anything significant for retirement, you need to be putting away at least 10% of your income. And then the question is, does that sound about right? Does that sound about right? And I have not had a person say anything other than, yep, that sounds about right. Because in their mind, 10% is not that big of a number. And they do need to be saving at least 10%. And you read anything about retirement, you watch any podcasts or anything like that about retirement, that's what people say. You need to be putting away at least 10% of your income. So you just ask them that. And then you say, does that sound about right? And they're like, yep, that sounds about right. And then I'm like, okay, well, you're making $100,000 a year. So 10%, that's $10,000. That's about $830 some a month. Does that sound about right? And again, most of the time, instinctively, they'll be like, yeah, that sounds about right. Every now and then, I've had a couple of them be like, hold on just a second. Let me do some calculations. They grab their phone. You see them punching in on their calculator on their phone. And then they come back and they're like, yep, that sounds about right. And you will be amazed at how much higher premiums you will get using that 10% rule. Because, you know, we've got to not have that fear that if I'm talking to someone who makes $500,000 a year, that if I show them something with a $50,000 a year premium, they're going to kick me out of their house. No, we can't be thinking like that, because to them, it's only 10%. It's not a big number to them. So we've just got to be thinking along the lines of that 10% of their income, 10% of their income. And there's been very few times that I've had people not do the 10%. Sometimes they'll do a little bit more. Sometimes they'll do a little bit less, but it'll be like $700 a month instead of $800 a month. Whereas if you ask them a question like, well, how much are you comfortable putting into this for retirement per month? You're going to get a much lower number, I guarantee you, because that's what I would ask them, and I got much lower numbers. And the higher you can get that premium up, the better the illustrations and everything's going to look. And, you know, the better it's going to be for the client as well, because, like I said, it takes time and it takes money. So use that question. Make this statement. You need to be saving 10%, at least 10%. Does that sound about right? And they're like, yeah. And then you just find out what that 10% is, ask them, and then be like, yeah, they'll be like, yeah, that sounds about right. So that's how you get to the getting them to put money in. You know, if you're and the other thing that I always stress is they've got to have all three. You could have a 24-year-old that health is just horrible, driving record is horrible. They don't have a whole lot of extra money to put into their policy. Maybe they would have more money if their driving record and their health weren't so bad. Maybe if they spent their money in different places, that would improve their health and their driving record. But be it what it is, they've got to have all three. You can't just have 2 out of 3. They've got to have the time to wait, the money to put in, and be healthy enough for it to make sense for them. So I hope that kind of clears up who are we looking for the prospect. Again, I'm not getting anything in the chat, but if you guys have questions, please put those in the chat box. I'll check my text. I've been getting a bunch of texts, but okay, I don't think I have any from this. Okay, so that's our prospect. So now let's talk about how an IUL works from a very, like I said, 30,000-foot view. We're not going to get into the weeds here. We're just going to talk very general. So let's say we have a 30-year-old male, non-tobacco user, healthy, and they're putting away money for retirement in something like a 401k. And we show them the benefit of how you can save tax-free versus tax-deferred, the benefits of that and all that. And they're like, okay, that makes sense. I think I want to, start putting money into something like this for retirement. And let's say that the 30-year-old wants to put away $500 a month, making $50,000 a year, $500 a month. That would not be, anyway, whatever the math works out to, $500 a month. So there's a lot of different ways that you can set these up. Typically, we will set them up to let's find the least amount of life insurance possible based on the premium that they want to pay. And we do that in order to keep the cost as low as possible. So let's say we do that, we're setting it up. We want to know what's the minimum amount of insurance that this 30-year-old has to purchase in order to pay $500 a month. And we have software that calculates that. Let's say the software comes back and says he's got to buy $100,000 worth of life insurance. So we're going to sell him a policy with a $100,000 death benefit. Well, we all know it does not take a 30-year-old male non-tobacco user $500 a month to buy $100,000 worth of life insurance. Let's say that the insurance costs $50 a month. So $50 a month, he's paying in $500. Only $50 of that is required to buy the life insurance because they are buying life insurance. So that leaves $450 there every month that's going towards his retirement. So when you have any type of universal life policy, even a whole life policy, you have a death benefit and you have a cash value. So the death benefit is the $100,000 we talked about. And then there's a cash value. That cash value is just extra money that they put into their policy that earns interest. So the $50 a month that's going to buy the life insurance, it's not earning any interest. That's a pure cost. When they pay $500, $50 is going to go to buy the life insurance, and then $450 is going to go into the cash to earn interest and grow for their retirement. So that's what we want that correlation to look like. That's why it's important that they be relatively young and healthy. because as we all know, two things that drive up the cost of insurance are age and health. So in order to keep that cost of the insurance low so that the majority of their money is going into their retirement savings, because they're doing this to save for retirement, not buy a whole bunch of life insurance, we want to keep that correlation to where it's very little going towards the cost and most of their money is going into their cash value. So that's easier. It's much, much easier when they're young and healthy. So hopefully that kind of makes the first two of my three things make sense. And obviously to save money for anything, you've got to put money into it. So, so the extra money goes in, it earns interest over time. Indexed, it's either going to go up, it's never going to go down, it's either going to stay the same or go up. If the market goes down one year, the money's going to stay the same. They won't earn any interest that year, but they won't lose any money. That's the benefit of indexing. So when the market goes down, their money stays exactly where it was. It just doesn't earn any interest that year. When the market goes up, they earn interest. They earn interest up to a point, and that's the trade-off for the fact that they're not losing any money. And so when they earn interest, that gets credited to their account. Their cash continues to grow and grow and grow and grow. As that cash grows, when they get into retirement, they can loan that cash to themselves, and they can do it without interest. There are interest-free loans, and they don't have to pay it back because technically they're loaning from their death benefit. So as long as that policy stays in force until they die, then that money that they take out while they're living is 100% tax-free, because like I said, technically they're borrowing from their cash because they don't have access to borrow from the death benefit, but technically it's coming off of their death benefit. So it's a loan because it's a loan, they don't have to claim it as income and pay income tax on it. It's kind of that wonderful little loophole in life insurance that makes all of this work. So their money accumulates, they start taking it out in retirement. All the money they take out in retirement is tax-free. Policy stays in force. They die. Whatever is left over for that death benefit goes to their family, 100% tax-free. So it protects them and their family while they're saving for retirement, because as they're saving, they've got that death benefit. God forbid something happened to them when they're young, they've got a tax-free death benefit that's going to go to their family. It helps them to have tax-free income in retirement while they're living, and then when they die, whatever is left over can be used for final expenses or just to leave to their family, whatever they want to do with it. So that's kind of in general how it works. Again, 30,000-foot view, not getting into all the nitty-gritty. That is not how I explain it to a client. Bits and pieces with the indexing, I kind of explain it like that. But the client doesn't need to know how the life insurance works. I want you guys to understand how the policy works so that when we talk about how the concept works, you understand why. You kind of know, we call it getting inside the hot dog. It's like nobody wants to know what's inside the hot dog. We don't tell clients what's inside the hot dog. Nobody wants to know that. Well, as agents, sometimes we got to get inside the hot dog and kind of understand how the policy works so that it'll help us to better understand how to explain it to a client. So I want you guys to understand how it works. Now, there's basically three things that I go over with a client when I do these calls. So typically when you talk to people, if they're saving for retirement, they're putting money in a 401k. That's, 90% of the time, the people that I'm talking to, that's what they're doing. So they're putting money in a 401k at work. So I ask them, how are you saving for retirement right now? And they say, putting money in a 401k. And I'm like, okay, great. So does your employer match what you put in? And sometimes they do, sometimes they don't. They match different percentages. None of that really matters. I'm just trying to get an idea of what they've been doing up to this point. So I'm like, okay, great. So you're putting that money into your 401k. And then I will talk to them about taxation. So the two real benefits that people see in the IULs is being able to get that money out tax-free and being able to earn good money without being at risk in the market. So I talk about those two things first. So, and I forgot to mention this earlier when I was talking about the prospect. So when you find a prospect and you're going to book that second appointment to come back and talk to them about their retirement savings, don't tell them it's life insurance. Don't mention IUL because they may Google that and find out that that's life insurance. Just tell them that you want to set up an appointment to come back and talk to them about some tax-free retirement options. Now, we're not being misleading. They understand by the end of the conversation with me that they're buying life insurance. It's just if I came up to you and you knew nothing about how you can save extra money in life insurance and get it out tax-free, and I'm like, hey, Stephen, I hear you want to save, you're looking for some different vehicles to save for retirement. I have this awesome life insurance policy that I want you to look at. People are going to be like, I don't need any life insurance. I'm trying to save for retirement. And it's because they don't know how life insurance can benefit them for saving for retirement. So we don't start with that. So as you, in the beginning, when you're talking to them, don't say, I want to talk to you about a life insurance policy or an IUL to save for your retirement. Just say we have some tax-free retirement options that I want to talk to you about. So when I'm in the conversation with the client, I'm a good probably 15 minutes in before they realize it's life insurance, because I'm showing them all the benefits of what the life insurance can do. Then I'm like, oh yeah, by the way, it's life insurance. And I have not had anyone yet to be like, oh, well, if it's life insurance, I don't want to do it, because they see the benefits now. So the first thing I'll talk to them about is taxation. So they're putting money in a 401k. I'll say, do you understand how the taxes work on that? Regardless of what they say, I'm going to explain it. Because it's kind of like when we ask people what kind of life insurance they currently have, and they're like, oh, I've got a policy. It's going to last me the rest of my life. And they have a 10-year term. It's like we don't go by what they understand. We want to make sure they understand it correctly. So I'll ask them, do you understand how the taxes work on your 401k? If they say, yep, I understand that, I'm like, okay, cool. So when you put that money in, you're not paying tax on it. It's going to grow tax deferred, but when you take that money out in retirement, you're taxed on 100% of it because none of that money has ever been taxed. And, most of the time they're like, yep, I understand that's how it works. And I'm like, okay, great. So that's called a tax. Like what I like to talk about is buckets, the tax deferred bucket and the tax-free bucket. So your 401k is a tax-deferred bucket. You put money in, you don't pay any tax. It grows, you don't pay any tax. You take it out, it's 100% taxable in retirement. Now let's talk about how the tax-free bucket works. And I typically do Zooms with clients, so I have graphics. I like have my two buckets on the screen so they can see it, because most people are visual, and it just helps them to better understand it. So I'll show them, okay, well, here's how the tax-free bucket works. You put the money in after tax. You've already paid tax on that money. You've received it as income, not like your 401k that's pre-tax. This, you actually go ahead and pay tax on it now. We call that paying tax on the seed instead of the harvest. And I like to use those words because, again, people are visual and they get that. And I say, what I mean by that is, doesn't it make more sense to pay tax on a smaller amount of money at a lower income tax rate now versus paying tax on the harvest on a larger amount of money, which could be at a higher tax rate in the future? And they're like, yeah, that makes perfect sense. And so you don't have to worry about that objection of, well, but if I put it in my 401k, I don't have to pay taxes on it. Yeah, you're going to pay taxes on it. You're going to pay tax on the harvest. Why don't we go ahead and pay taxes on the seed and be done with it? So we're going to put that money in after tax. It's going to grow. But the cool thing is about this tax-free bucket is what was 100% taxable over here. If you put it in this bucket instead, then it's going to be 100% tax-free coming out, because you've already paid tax on what you put in. You never have to pay tax on any of that gain. So when you take it out, it's 100% tax-free. So instead of putting it somewhere where it's 100% taxable in retirement, This gives you the option to put it somewhere where it will be 100% tax-free in retirement. And they're always like, wow, that sounds awesome. And I'm like, okay, so that's the tax thing. So we're able to, through a vehicle, give you the ability to put money away today and not have to pay tax on it. Not have to pay tax on that harvest later on when you take it out in retirement, tax-free income in retirement. Then what I'll do is I will ask them if they could design their own retirement plan, if they got to, pick how it worked, what would they want their retirement plan to do for them? And typically the first thing I get is something like, well, I want it to grow. And I'm like, yeah, most people do. Or they'll say things like, I want to make sure that I have enough money, coming in retirement that I can live comfortably. I don't have to worry about, am I going to be able to pay for my medications? Or, you'll get some answer on the line of, I want the money to grow. So if they say, well, I just want to make sure that I've got money in retirement, that's one of those not very specific answers. So I'll say, well, what I'm hearing is you want it to grow. You want to make sure you're getting good growth in this product so that the money is there when you're ready to retire. And they're like, yep. And I'm like, okay, so what else do you want? And then typically, because we've just shown them the tax-free bucket, they'll say, well, yeah, I'd like to get it tax-free. I'm like, yeah, paying no taxes is always better than having to pay taxes. And a lot of times people will say, I don't like losing money in the market. Sometimes they won't say that, but a lot of times they do. If they don't bring that up, I will ask them. Because some people will give you some answers right off the bat. And some people are like, well, I've never really thought about it. But, this is what I'd want. And you have to kind of prompt them to get the information out. So if they don't say, I don't like losing money in the market, or I don't like it when, there's a crash and I look at my 401k statement and I've just lost 20% of my retirement, then I will ask them. I'm like, well, how do you feel about losing money in the market? Are you okay with that? And like 99, actually, I think 100%. I don't think I've had anybody say, yeah, I'm all right with that. They're like, no, I don't like that. I'd rather not lose any money. I'm like, okay, yeah, most people are like that. So those are kind of the big three that you get. The fourth one, a lot of times, is they want access to their money. They want to be able to access it when they want it, liquidity, things like that. So those are kind of the four things that we're looking for. So I talked to them a little bit about the tax-free side of things. So I'll say, okay, well, one of the first things you told me you wanted was growth. So let's talk a little bit about how this grows. And I'll ask them, have you ever heard of indexed interest or indexing? Most of them say, no, I've never heard of that. A few will say, I've heard of it, but I really don't know how it works. And I'll be like, cool, most people have never heard of it, so not a big deal. I said, so here's how I explain indexing. 3 things your money can do. It can go up, it can stay the same, or it can go down. You've already told me you don't like it going down. You don't like losing money when the market goes down. So that's what indexing does. Indexing protects you from losing money in the market. So it eliminates that downside. So now all your money can do is stay the same or go up. And here's how it works. So market goes down, you don't lose any money. You're probably not going to earn any interest that year. You probably get 0% interest that year. But the cool thing is, if that money had been in your 401k, you would have lost 20% if the market went down 20%. Here, market goes down 20%. You don't lose anything. You keep everything that you have. So that's what happens when the market goes down. But the market does 2 things. It goes up and it goes down. So let's talk about when it goes up. So when it goes up, you're going to earn interest. But because we're protecting you against all the losses in the market, there is going to be a maximum on what you can gain. And that's the trade-off for the fact that you're never going to lose any money when the market goes down. So, you'll earn interest up to a point that the market may keep going above that, but you're not going to earn over whatever your maximum is. And I'll say, does that make sense? And most of the time people are like, yeah, that makes sense. And then I usually give a numerical example just to kind of make sure that they understand. I'll say, okay, so let's just say that your maximum for this year was 10%. So if the market goes up 8%, you get to keep it all because it's underneath your maximum. If the market goes up 10%, you get to keep it all. But if the market goes up 15%, you're going to get credited 10%. But if the market goes down 15%, you don't lose any money. And I'm like, does that make sense? Every single time they're like, yep, that makes sense. So that's how I explain how it's going to earn interest. I keep it very, very, very basic. These conversations are typically, I think, at the longest, and that's showing illustrations, running the illustration, showing them the illustration, explaining the illustration, going through how it works, answering all their questions. There may be at the most 45 minutes. So it's, I keep it short and brief and basic and simple. Because that's what people understand. I have to make it simple so I can understand it, and it helps me to explain it to other people if I can keep it simple. So I just tell them that's how you're going to earn interest. When the market goes down, you're not going to lose anything. When the market goes up, you'll earn, but there are going to be some maximums. And some years you're not going to get all the gain in the market, but the cool thing is you're never going to take part in any of the losses in the market. So I explain that to them, and I'm like, okay, so that's how your money's going to grow. You're going to be able to get it out tax-free. Oh, yeah, and by the way, this money that you're putting in is your money. You have access to it whenever you want, for whatever you want. You don't have to wait to a certain age to retire and be able to access this money. It's your money, so you have complete access to it. So I've talked to them about growth. I've talked to them about tax-free. I've talked to them about safety, and I've talked to them about liquidity. On the growth, I will tell them. So I tell them how the indexing works, and I'll tell them now, we have no idea what the market's going to do in the future. We have no clue. But we do know what it's done in the past. And over the past 25, 35, 45 years, these products have returned an average of 6 to 8%. Now, again, I'm not saying that you're going to earn 6 to 8%. I'm just saying that based on the previous history of the market, you're looking at about a 6 to 8% average annual return, meaning some years you might get 11%, some years you get 3%, but over time, an average of 7% per year. And they're like, oh, okay, well, that's pretty good, considering I don't lose any money. And I'm like, yeah. And so I go through illustrations with the people and kind of show them in detail the numbers and things like that. But when I'm explaining it to them, initially I just tell them, we don't know what it's going to earn in the future, but based on the past, you're looking at somewhere between about a 6 to 8% return. So they're excited. They're excited that they can get a good return with no risk in the market. They can get to their money anytime they want, and they can take it out tax-free. Then I say, okay, well, the way we're able to give you all of these things is actually through something called an indexed universal life insurance policy. And they're like, oh. And I tell them there are just some tax benefits in life insurance that people don't know about. People don't realize. They think of life insurance, they think they have to die for anything to get paid out. And actually, there's a lot of ways that you can access your life insurance while you're living. And people just aren't aware of this. And so these indexed universal life insurance policies allows you to earn that indexed interest. And I'll tell them it's like, I like to think of it as a life insurance policy with a savings account built into it. So you pay money in, some of it goes towards buying life insurance, but you put extra money in, and that goes just into like a savings account, and it's going to earn that indexed interest we were talking about, and it's going to grow and grow and grow, and then you're going to be able to access that money tax-free in retirement. So I keep it pretty simple, and then like I said, I'll get into some illustrations and get into showing them examples and things like that. But that's pretty much how I explain things to the client. So last thing I want to make sure that you all know is if you're like, I'm still, I'm listening, I'm taking notes, but I still don't feel like I'm comfortable explaining this to a client. That's fine. Just find the client. Find the client that has those 3 things we were talking about. Find the right prospect and get with someone who can help you. It may be your manager. I am here to help you as well. And you can book appointments with me. I'm going to type my Simply Book, I can't type and talk at the same time, link into the chat box. So if you happen to be watching the chat box, I'm going to put that in there, as well as my phone number, because the Simply Book Me site is really, okay, that's not an accurate phone number. 336-212-2041 is my phone number. That first one has too many digits in it. If you just have a question, just call me, text me, whatever. The Simply Book Me site is if you have a client that you're like, okay, I found a person, but I can't explain all this to them. And you want to book an appointment on my calendar for you, the client, and me to have a conversation. And like I said, typically it's a Zoom, and so that I can show them some visuals to help them kind of understand things. And I'll go through, and I'll help you with whatever it is that you need help with. If you're like, all I've told them is we have some tax-free retirement options, and we just need to bring the expert in to come and talk to them. And I didn't go into it at all, that's fine. I'll start from the very beginning, just like I talked about, how are you saving for insurance, and how are you saving for retirement and things like that. And I'll go through it. I'll explain everything. I'll do the illustrations. I'll explain the illustrations. Whatever you need help with, I'm here to help you. The call that I had right before this, the agent had kind of gone through and they had explained the general concept to the client. They used the IUL ATM that we have that's out on the university, and it goes through a lot. It's got those buckets that I was talking about. It's got that analogy in there. It's got a lot of the information that I go over is straight out of that IUL ATM. That's what I have up on my screen, and I go through some of those slides with them. And they had done that. But the client had some questions the agent wasn't real sure how to answer. So he brought me in and said, we've gone through, we've talked about the concept. He understands the concept. He just had some specific questions, and he did. And I said most of his questions were going to be easily answered by showing him an illustration. So I did a real quick illustration and showed it to him and answered his questions. And he's like, okay, it makes sense. So whatever you need help with, I'm here to help you. But when you've got a client that you want to book an appointment on my calendar, and again, all you've got to tell them is, let's say you've helped somebody with mortgage protection and you find out they're putting money in a 401k, and they're young, they're healthy, and they've got, they're putting the money in their 401k already, so that we've got access to some money that they're saving for retirement. And you're like, well, all you've got to say is, what I'd like to do is talk to you about some retirement options. Have you ever heard of tax-free retirement? Or what are you doing to save tax-free for retirement? Nobody's ever heard of it. Hardly anyone's doing anything to save tax-free. So let's say I've never heard of that. You can be like, well, we have some options to help people save tax-free for retirement. And what I'd like to do is set up an appointment for us to talk to one of our experts. And, just bring the specialist in, just like you go to the doctor and your knee's hurting and he's like, well, I think you tore a ligament, but I'd like to have, a knee doctor, whatever they're called, orthopedic, I think it is, look at this and make sure we're on the right track. That's all you're doing. You're just bringing a specialist in to help you, help you learn and explain everything. So I'm a partner. Just say, hey, I've got a partner. Her name's Gina. She's an expert at this. Now, the only reason I'm saying I'm an expert is I've done this a long time. It's nothing special about me. It's not that I'm super smart. It's that I've been doing this for like 24 years. And so if I'm not good at it by now, something's wrong. So that's the only thing that qualifies me as an expert, is just doing it over and over and over and over for a lot of years. Just let them know, hey, what I'd like to do is bring in one of our experts so we can have a conversation, make sure you get all your questions answered, and we can explain everything to you and see if this will work for you. So that's all you got to do. Just book another appointment. Go on to my calendar link, ginahawkes.simplybook.me. Book it in there, and then we'll just have a conversation with the client. I'll typically call you ahead of time and just kind of get a little background on what you and the client have talked to up to that point, so that I'm not going into the appointment completely not knowing what's going on. But it's, it's a pretty simple process. I will run the illustrations for you. I'll explain the illustrations to the client. I'll answer all their questions. I do pretty much everything but fill out the application. And you fill out the application and you get paid all the commissions. And I am just a resource here that Andy Albright has brought in to help you guys in many different ways. And this is one of them, in helping you to explain these to clients. Because it is a little bit more of a, it's not difficult as all. As you can see, it's not at all difficult. It's just knowing the right way to explain it simply to a client, and not overwhelm them with information, but just give them what they need to know, that they can understand it, understand how it works, and understand how it works for them and the benefits for them. We had a question. Doug asked, are there height, weight restrictions? Yes, Doug, there are. For every single one. We sell IULs primarily with F&G, Fidelity and Guarantee, NLG, National Life Group, and Allianz. So those are the three companies that we use, and all of those do have a height weight guideline. So yes, that comes into play as well. So another thing to keep in mind when we're looking for that right client. So Stephen, that's basically what I have. I know we've got a couple more minutes if anybody has any questions, or if there's anything else that you'd like to add.
That was fantastic, Gina. Good stuff. And, it's one of those things that it's kind of like anything you're first intimidated of, when you kind of break it down like that, you go, oh, it's really nothing to be scared of. And I appreciate all the resources that you make available. What we could do is, let's see here. If you have a question and you want to throw your blue hand up, just so we don't have chaos, what you do is just click on your name. It'll say raise hand. And then I'll call on you and you can unmute yourself and ask your question, or use the chat box, whichever makes you feel more comfortable. And
Doug had a question, and then I just responded privately to his question to Rogers, so that's not going to help him. You'd think by as many times as I've used Zoom, I'd have this down by now. So Doug asked, are the guidelines, the height weight guidelines, in a cheat sheet? Doug, they're actually in the they are in the height weight guidelines on NAA University. So that one document where we have everybody's height weight guidelines together in one place, yes, they are in there. So I think that's what you were talking about.
Thank you. And I see AR, I don't know if that's Andrew or not, but go ahead and fire away, buddy.
Oh, no, it's Adam Rosen.
Oh, Adam Rosen.
Yeah, cool fish.
I had two guesses with AR.
Is there any particular reason why you didn't say Mutual of Omaha in choosing IULs?
We do use Mutual of Omaha's IULs, but kind of in a little bit of a different way. So their new product, the IUL Express, that is good for somebody that maybe they need insurance, number one, and they like the fact that they can put a little extra money in and grow it for retirement. Then the IULE, that is a great product. It is simplified issue, so they don't have to go through a medical exam and all that. So if that's an issue, it's just because it is simplified issue, there are some restrictions, like you cannot go over $300,000 in the death benefit. And depending on what the client is, how much they're looking to pay, you may need a higher death benefit than that. So we do use the IULE. And Mutual of Omaha has some other IULs. Their IULs are just more geared towards death benefit, where the other companies that I mentioned are more geared towards cash accumulation. So we do use Mutual of Omaha. They have some great products. They're just not really geared towards cash accumulation. So if you've got someone looking for cash accumulation, the other companies are typically better.
Adam, all my IULs on me, Holly, the kids, all of us are either F&G or NLG, because those are, yeah.
Yeah.
The Mutual of Omaha Express one's more like a smart UL-ish type situation. But good question, Adam. Any other questions, guys?
Rogers asked, which carrier do you use? Do you pick a favorite and stick with it? That's perfectly fine. I would say in the beginning, pick one and get good at it. They're all great companies. You cannot go wrong with any of them. Just like Stephen said, I have F&G policies. I have NLG policies. So yeah, just they're all great. You can't go wrong with any of them. But when you're learning it, it's easier to learn one really, really, really well and then kind of move into the others versus trying to learn, 3 at one time.
Very good. Any other questions?
Yeah, I got a quick question. So can you get run illustrations in WinFlex for F&G? Because I've just been fooling around with that and just noticed Mutual of Omaha. I'm not sure if that's part of the WinFlex program. Do you guys know? Or is that just something I'll call broker services and then they send over the illustrations? So
WinFlex is specifically Mutual of Omaha. So the other carriers use different. Actually, Allianz and NLG use the same platform. So when you go to run the illustration, it's going to look exactly the same. Each of them, you just go to their website and you'll find their illustration software on their website. But yeah, none of those three are WinFlex.
All right. Any other questions, guys? And it's an open dialogue. That's why Gina, gave you her contact. Feel free to shoot her a text if you've got a question later.
Absolutely.
And we've got this recorded, so Chandler will post it on our YouTube page and post the link on the band. I can have him send you a copy. I think you're on our band anyway, or I can have Chandler send you a link, Gina, if you would like to use it as a resource to send people as well.
Okay, awesome. Yeah, that'd be great.
I appreciate it. That's awesome. Appreciate all your help. Guys, all you got to do is write one. I'm telling you, it's like the scales fall off your eyes. It'll be like, oh, why was I scared of this? At least that's how I felt after I wrote my first one. I was like, why was I scared of this? There's nothing to be scared of. So, Gina, appreciate you helping us, and we'll thank you with results. That's what we're going to do. So,
sounds good. Yeah, and the best way to learn these is write one on yourself or somebody, your kids or somebody. Then you really learn it, and that's one of the reasons I'm so passionate about these is because I own them and I've seen the benefit and how amazing they are. So when you own them, you have that credibility and that passion to talk to other people about them.
Yep, and with the NLG app, you can put your policies in the app and pull it up and show it to clients. Like, here's my cash values. Here's how that's power. You just can't fake that. I mean, it's powerful. So,
yeah.
Awesome. All right. Well, let's get out. Let's get after it. I know a bunch of you guys are going to get back over to the dial jam we got going on, and we will. We're gonna thank you with results. Thank you, Gina.
Absolutely. Thank you, guys.